Let's start. Now we are continuing with the same discussion that we started last week on financial institutions, and we divided financial institutions into three broad categories: central banking and financial intermediaries, as well as financial service providers. So we started discussing, actually central banking we have already covered in a few sessions, and we also started with discussing financial intermediaries. And before moving to the discussion today directly, I thought of coming back to our very traditional question, all question, or the advice on financial news. Now this week, in case of Sri Lanka, related to financial information, we have seen some important development. As I always say, you have to follow the central banking news, what's happening with the central bank, and especially the monetary policy developments. I always encourage you to look at those information. Now, what has happened this week? The central bank issued its monetary policy review in August. I think it was on Thursday morning, and central bank made an announcement with regard to monetary policy and certain, changes related to monetary policy. So I wonder whether you could had a chance to look at the monetary policy review, but I'm sure if you couldn't do it, the most of the newspapers, they have captured the news in relation to monetary policy review and some related developments. So probably let's take few minutes at the beginning to discuss some of these information in what you can observe in the monetary policy press release. Now, in relation to monetary policy stance means what is the current direction of the monetary policy. What has the central bank done this week? Whether the monetary policy is tightened, or monetary policy is relaxed, or monetary policy is maintained at the same level. What is your observation if you had a chance to look at the monetary policy, or even you can take a guess given the current situation? What has happened? So that is my first question. So what is the monetary policy stance of the central bank right now? Whether it is relax or tighten, or the central bank has decided to maintain the same? Maybe you can give your answer. I see more than 20 people have already joined. Even you can type your answer here if you are really shy of talking. Maybe you can simply type your answer. What is the current monetary policy stance? What do you think? We have a couple of people here, a couple of, in the sense, our team in the class. A lot of people are online. What do you think? Can I ask, can I call names as usual, or do you have any answer? What really has happened? The monetary policy is tightened, relaxed, or maintained at the same? What do you think? Chandu, Dilshani, Dinetma, Gishani, Hansini, Inoka, Janani, any of you? Do you have any answer? Maybe I'm calling with some other people's name, because if you are using some others, logging details of one, but these are the names I see. Any answer? It's okay if you couldn't do it, but let's try to have a discussion. What do you think? I mean, if you couldn't have a look into the review, the statement, uh, what can you assume in the current setup? Monetary policy, is it tightening or relaxing? Overall, what is our current monetary policy cycle? Whether it is tight or relax? Tight means interest rates are basically on an upward trend. Relax means interest rates are basically on a downward trend. Does anyone want to have a response? Relax. Yes, Krishni, it's relax. Okay, we have started relaxing sometimes back. Now still the policy is relaxed. Correct. Excellent. So in this recent review, what the central bank has decided to do, whether it has decided to continue with that relax or just to change its policy, what has done by the central bank? Are we continuing with the, yes, it is continuing. The same monetary policy stance is continuing, which means we are having low interest rates. So as a result, it indicates the relaxed policy stance is continuing. Do you have any idea why we have to have a continued relaxed policy? Probably you can have some imagination. Why it is relaxed? Why do we need to have relax means low interest rates, having more money in the economy, allowing people to do more borrowings from the banking sector. Why do we need to relax the stance right now? What are the uh, basic variables we look at? Just tell me a couple of variables that we are basically having some concern or having some consideration that we are, basically following in terms of the policy variables. Why do we need to have a relaxed policy? I'm asking these questions because in your exam paper, surely these are, aligned with your questions. Okay, Krishna says to make sure that flow of the economic situation is smooth. Yes, correct. We have to ensure that economic transactions and then activities are happening. Why it is needed in this case, especially? What are the conditions that we have? Why you need to allow economy to run smoothly without disrupting? Any idea? I'm sure Krishna will have idea, but others also I'm encouraging them. Just imagine, why do we need to support the economy? So this answer clearly suggests we have to support the smooth economic activities. Why? Why cannot we disturb, or why cannot we raise interest rates and stop it? Why there is a clear case that we should support? This is my final question. Why is that? Okay, Vimandi says to bring the economy to a stabilized position. So I think what Imandi says, we have to have some, growth, right? Right now, our economy is not growing. Especially our economy is actually struggling. And to worsen that, we have experienced uh, this unfortunate situation of the COVID pandemic. So during the COVID pandemic, our economy is badly hit. We know a lot of economic activities are, was under trouble, was actually, not performing as we expected. So we need to support the economy. We need to bring back the economy to a growth path. Why we can do it very easily right now? We can support lower interest rates and more money in the economy because our inflation is under control. Our inflation is, moving very closer to 5%, 6%. So it's not a big deal, big concern. If we have, something like 20%, 30% inflation right now, probably we may, be very cautious in relaxing monetary policy further, because that will further destabilize the economy. But right now we see inflation is actually under control. So I really encourage you to look at the press release, because it contains some valuable information. And let me show you the press release, at least if you have not seen it. Okay. So this is the monetary policy press release this month. So it clearly says the central bank decided to maintain their two basic interest rates. What are these interest rates? The stand-in deposit facility rate, stand-in lending facility rate at current levels of 4.5, 5.5. And these rates are important in your exam paper. Sometimes these are 2 marks questions, right? So the current interest rates are maintained with an accommodative monetary policy stance. Accommodative monetary policy stance means you are accommodating, means you are supporting, you are relaxing, you are giving more space to the economy. So the central bank is maintaining accommodating policy. Why? The central bank wants interest rates to go down further, because the central bank has taken a lot of measures, and it is expecting that interest rates would be coming down in the economy to support the economic activity. And in addition, some measures are taken. I'll come back to that point later. So what are the reasons? So in the following paragraphs of the central bank press release, it suggests the reasons why do we keeping this policy. So one reason is global monetary policy easing due to the rapid spread of coronavirus. Now we see a lot of countries are also doing the same. Their monetary policy is being relaxed largely because of the rapid spread of the COVID-19 pandemic. And we know now this COVID pandemic has become really a global threat. Now I think more than 23 million cases reported, roughly 800,000, closer to 1 million people dead. Although we are lucky that we are basically under control in this country, a lot of countries are suffering heavily with the COVID-19 impact. And as a result, this year, we think the global economic growth would be negative 4.9. So it's a large contraction, which means you are getting poor compared to last year by 4.9%. That is the message, right? So if you were in a better position last week, let's say it was 100 last year, now this year it will become 95. So you are becoming poor when the growth is contracting. So the whole world is going to experience this issue. So as a result, most of the economies are implementing monetary policy measures, easing measures, lot of interest rate cuts, SRR cuts, other special liquidity injections, those are happening. Domestically, our economy is also affected by the COVID-19 pandemic, right? So in our first quarter, our economy grew only by 1.6, but it is a contraction, not a growth. So we got poor in the first quarter by 1.6%, which means we are basically experiencing the impact of the COVID-19. And also the second quarter, third quarter, we will have same issue this year. Probably we might not grow in the uh, in the 2020. So we need to support the sustained growth momentum, which means you have to give more space to the economy without disturbing by raising or changing interest rates or changing money level. So that is one reason. Second reason that we can maintain the relaxed policy. Third reason, we can give support to the economy by having low interest rates because our external sector has improved to some extent. Now we know we are struggling with low foreign exchange earnings. For example, tourism is extremely hit. A lot of hotels, their jobs under threat. So it's the most severely affected sectors, external earning sectors of the economy. Remittances, they are getting slowed, or sometimes we are not receiving adequate remittances because even those countries are affected. So exports are also low. Good thing is, I think in the month of June, we have seen some pickup of exports, but up to that point, on a cumulative basis, exports are negative. So we are not having good earnings in terms of foreign exchange. But on the other hand, there are some restrictions against imports. Now imports create demand for foreign exchange, and that creates pressure exchange rate to depreciate. So the government and the central bank is continuing with some measures to stop unnecessary imports, because you cannot import luxury items, you cannot import non-essential goods, you cannot import vehicles at this moment. So there are some restrictions placed in. So as a result, imports are low. Exports are relatively good. Imports are low means we have some good condition in the trade account. And last week also we discussed, we have received some external financing. The Central Bank of India, Reserve Bank of India, they have given some facilities for us. So with that, our external buffer, currency buffer, has gone up. So all these are pointing to less pressure on the exchange rate. So when you don't have pressure on the exchange rate, that is giving some support to maintain relaxed policy. So relaxed policy means you put more money to the system at low cost. So if people are not using that money for unnecessary demand for imports and foreign currency outflows, then you can basically maintain a relaxed policy. That is also one reason. The other reason, as I said, no inflationary pressures at the moment. Right now, inflation is basically around 5%, 6%. Yesterday, national inflation numbers released, that is also 6.1%. So, which means there are some short-term variations. For example, due to food price changes, there could be some variations in the prices. For example, onion prices, fish prices, when those are changing, inflation could go up or go down in a month or so. But it's not a permanent change, so which means we consider that as a temporary shock. So the long-term inflation driven by the demand is relatively under control. Now to prove this in the press release, you have this tool. We call it a fan chart, right? Fan chart means because it's like a fan. If you look at this chart, it's like a fan. Fan indicates the probability of having high inflation or low inflation. It's a probability. Forget about the probability, just focus on the blue line, the dash line that indicates for next few quarters, 2020, 21, 22, up to that point, inflation is going to be around 5%. So the fan chart also suggests in the near term or the medium term, inflation will be low. So we have some space to relax the policy, keep the relaxed policy. Slow growth in credit to private sector. Now, with all these things, what we expect to support the economic activities, people should borrow, people should, spend money on economic activities, and that is needed at this point. So one indicator to monitor that is the credit to private sector indicator. I think we discussed that under monetary money compilation. So that is one indicator. So what we really need is some pickup in this credit to the private sector. Private sector means your borrowings. Your borrowings are calculated as a whole as private sector borrowings. So right now, especially in the month of June also, we have seen people are not borrowing much. Actually, borrowing has gone down. There is large enough money in the system. Interest rates are also low, but still people are not borrowing, probably due to wait and see policy. Due to the uncertainty, this is before the election, maybe people were waiting until the elections are over, so could be various reasons. And also still the interest rates are declining, right? The full effect is not gone to the interest rate yet. Banks are still in the process of adjusting rates, so people are maybe they are waiting and see about the near future, and probably they will start borrow. So credit growth is low means we have to support credit growth by having low interest rate. So for that you need to have relaxed policy. So all these suggest, all indicators are supportive to have relaxed policy. So in that case, the central bank is maintaining a relaxed policy stance as indicated by these uh, interest rates. So these are the official interest rates right now. I really recommend you keep these in mind. What is the standing deposit facility rate? What is the standing lending facility rate? What is the current bank rate? What is the current statutory reserve ratio? And when you have this ratio, you need to be able to calculate the money multiplier. Remember, we did all these things. So that is very important. In addition, one important policy is introduced this time. So that is also an important thing that you keep in mind. What the central bank has observed recently, there are some segments in the economy, still rates are not adjusting, at a clear or faster rate. And there are some segments we see basically interest rates are having, at higher levels. For example, these rates, you can consider them as some sectoral interest rates. Now, these sectoral rates basically affecting some small type of borrowers, a small type of, customers. Now, what are these rates? Now, you call them as regulated interest rates. Regulated interest rates means these rates are actually given by the central bank, to the banking sector. That's why you call them as regulated. So regulated rates are basically having maximum minimum rates for certain sectors. So there are some maximum rates on certain products. Actually, these are product wise interest rates. So the maximum interest rate on credit cards, it was brought down to 18%. Now, credit card interest rate is basically when you exceed the grace period. Now, when you use a credit card, you have a grace period, no? 51 days or so. So after that, the credit card issuer bank will charge you. So I think until recently, the rate was 28%. Now it has been reduced to 18%. So credit cards brought down rates. Maximum interest rates on TODs, pre-arranged TODs, was brought down to 16%. Maximum interest rates on pawning facilities. Pawning means you are basically keeping your jewelry as collaterals, gold, items as collateral, and you can borrow. It's one of the most secured way of lending. So that rate has brought down to 10%. And also penal interest rates. Banks are charging penal interest rates on, regular interest rate. So that penal rate was brought down to 2 percentage points. So the penal rate only could be 2% added to the normal rate. So these information is important for your exam. So probably there could be a question, we don't know what are the areas that the central bank has put some maximum rates in terms of regulated interest rates. So you should know, at least if you can't remember the rates, at least you should know the rates on credit cards, rates on pre-arranged TOD, rates on pawning, penal rates, all these have taken or brought down. So that is really important. So I really recommend what I have highlighted in this, in this press release are really important. So you should have some idea about this thing. Okay, so that is really important. There will be one more press release on 8th October. I assume this will be your last press release before the exam. So the exam, I heard it will be in November. So before that, the 8th October, there will be another statement. So in that statement, there could be further changes to these, policies. Make sure that you know them, because it could be in your exam paper. For example, we never know. These rates could be changed on October 8th. So those are the important numbers that you need to know. So my recommendation, my request to you is basically look at this press release before your exam. Okay? Even this press release you should read, and you need to get some idea what really happens in the economy. And even after this, subject, maybe by November you will be writing the exam paper, you will be completing this. But my humble request to you, always keep a habit or make a habit that you look at this press release on a regular basis. Every month, I think 1.5 months, you will have this. Then you will know what is really happening in the economy. You, as a student or a financial sector professional, university student, you should know what's happening in the economy. Right? Think about your, let's say, you are studying this subject, someone asks about you, asks from you, what are the interest rates, what's going to happen, what are the, economies, developments, right? If you can't answer, I think it's not good that you are a student studying in finance and you don't know what's happening in the financial system and the economy. So my really humble request, as I always tell you, look at this statement every whenever it is issued. Okay, so that's what I wanted to discuss at the beginning. Anyone wants to raise any issue on the information on the press release? Does anyone want to say something? I really see the three people are responding to me. Janani, Krishni, Vimandi, do you have anything to say about this discussion? Or any other person wants to highlight or ask any question? No? Clear? Okay. We can move to our regular discussion there. Let me open the presentation for the our normal discussion. So as I said, we were talking about financial institutions. We started discussing about banks. Okay. So this is the place I think we stopped last week. I was telling you the banks are not doing any charity work. They are to make profits. Why do they need profits? They have to pacify, or they have to make sure that their shareholders are earning returns for their investments as shareholders, and also the bank should ensure their clients, especially the borrowers and investors, sorry, the depositors and investors, for them the banks are paying a better rate, better return. So for that matter, the bank runs a kind of a business, a strategic business, to earn profits. We know there are key businesses, as a transformation, which means you are taking deposits from the public and using that deposit to create loans or to make investments to generate returns and profits. So those are that is the basic model of a bank, and when they are doing it, they are subject to various considerations. For example, their capital levels, liquidity levels, their sustainability, profits. All these are their key considerations. So that was discussed last week, and the bank's business model in that case is having some key areas that we have to keep in mind. So one, in their business model, one strategy, deposit taking, which means how they collect money. Borrowings also done by banks. That is also one way of getting money for their business. They do lending. That is how they earn money. They do investments. That is how they earn money. And they also provide payment and financial services. With all these activities, the banks are the most important payment service providers in terms of facilitating transactions in the economy. So banking sector is a conduit in the economy that takes money from certain sectors to other sectors through their payment mechanism, okay, and settlement mechanism. So that is where we have stopped last week. So The bank business model, in this few slides, we are discussing to a greater detail. They generate revenue through mainly through few sources. So revenue, simply you can call it R. Banks R is a function of various components. What are these components? Banks are earning interest. Banks are earning fees, basically through their services and financial advisory services. Interest is generated basically through their activities like lending and investment. The fees and charges are basically derived for their other services. Okay, so the bank's profit is basically coming from this revenue, the difference between this revenue and the cost, right? So the cost is basically simply reflecting what the bank has to spend in terms of doing their activities. For example, to raise money, they have to uh, collect money from the depositors. So for the depositors, they have to pay an interest. They also get money from other sources of funds, as I said, borrowings. For that also, they have to pay interest, right? And as I said, they charge interest on their lending activities. So in a simple sense, the bank profit, you can say profit, if you call it as, let's say, P in, in traditional finance books, you will see it as, the Greek letter pi, right? Pi is the symbol for profit. So the pi equals PR minus C. R is the revenue generated mainly from interest and other fees, minus C equals their cost of providing services, basically uh, in terms of deposits and other operational costs. Now you can simplify it saying the bank interest, the profit is simply the interest spread. Actually, what is the interest spread? The bank earns what the bank earns or what the bank pays. So the difference between interest income and interest expense, you can simply call it the spread, or the difference between the lending interest rate and the deposit interest rate is simply the interest spread. Some people, they used to call it NIM, NIM, net interest margin, right? Net interest margin. So that is simply if you take the interest component only. So interest components difference is the profit. Okay, profit can say, okay, the net interest margin is equal to basically the interest income and the interest expense. Now, other than that, banks are earning interest by providing fees, as we have mentioned here. So now this R is not only actually interest, there is another component, fees. So the fees are provided or earned by banks for providing various services, transaction services. For example, if you take some advisory service from a bank, you have to make a fee, give a fee. Or if you, let's say, buy a foreign exchange from a bank, you have to give a fee price or a margin. Likewise, let's say the bank is providing some other service, a checkbook, you have to give a fee. So those are called as fee income, which is a stable revenue stream. Interest is not stable. Why? We know when the central bank is changing interest rates, the banks have to change their rates. So which means the interest income is volatile. It's not stable, changing time to time. But fees are basically considered as a stable form of revenue, which means time to time it does not change. Only it will change when the bank revises fees or there is a large drop in fee-based activities. Otherwise, it's a stable revenue stream. So this is how banks do business. In that sense, bank business activity can be divided into two areas. What are these two areas? Bank activities can be divided into two areas. One, you can call it as a uh, uh, you can call them as on balance sheet activities or off balance sheet activities. Those are the two areas. uh, on balance sheet activities are one way of doing business. Off balance sheet activities are one way of doing business. So the total bank income is derived from both on balance sheet and off balance sheet uh, activities, both on balance sheet and off balance sheet activities. So total income in that sense, that R that I was telling you, R equals the income generated from on balance sheet activities and income generated from off balance sheet activities. In other words, I told you R means the revenue equals interest plus fees, right? Interest plus fees. So interest is basically coming from on balance sheet activities. Fees are basically coming from off balance sheet activities. So this is the most traditional way of discussing this thing. Fees are related to the bank's on balance sheet transactions, sorry, off balance sheet transactions, and uh, interest is related to on balance sheet transaction. Probably I'm not so sure whether I made a mistake. I'll repeat again. Interest are related to on balance sheet transactions. Fees or charges are related to off balance sheet uh, transaction. So that is the typical, kind of a setup that we can establish at this point. So in the following slides, we are discussing them in a detailed manner. So let's start with on balance sheet activities. On balance sheet activities are simply the activities written or mentioned in the bank's balance sheet, right? Bank balance sheet is simply the financial statement. So in the financial statement, you basically have two sides, right? You have an asset side, you have a liability side. I hope you have seen or you can recall or you have studied these traditional T accounts. T, you, let's say you draw a T letter T, and on the left side of the T, you have one set of financial variables. On the other side, there is another set of financial variables. This is called as an accounting form, traditional accounting form. Now, actually, in modern days, you don't prepare these T accounts because everything is, basically automated or computerized, so you don't need to prepare T accounts, but the principle is the same. So balance sheet is a kind of a T account that you have assets on one side and liabilities on the other side. So usually assets are on the left hand side of the T account. What is there in the asset side? So that is basically banks, what the bank owned, right? So what is the bank's, what is in possession actually, the bank's possession. So these are the financial resources that the bank used to make investments or loans to borrowers. So the asset indicates basically what the bank has done in terms of creating money or creating assets in terms of using its funds. So there are four major types of assets on the balance sheet. In a traditional balance sheet, you have cash in hand. Under these, there are various other items, but I'm just telling you the broad items what you can observe in a bank balance sheet. On the asset side, you have cash, you have investments, you have loans and advances, you have fixed assets. Cash is very clear. Cash is basically currency, notes and coins. Notes and coins can be in the bank's vault, right, in their drawers, or can be in collection, right, sometimes, or can be with the central bank. Remember, the banks are maintaining a reserve requirement with the central bank. That reserve requirement is basically cash in hand because it is one of the most liquid assets. So cash in hand simply indicate liquid assets that the bank has in its balance sheet. Investments simply reflect where the banks have invested to earn money in terms of financial instruments. So financial instruments are basically fixed income securities like bonds, bills, commercial papers, etc. Or could be variable income securities like stocks, shares. So banks are doing investments in these instruments, bonds and shares, bills or shares. So that is called as investments. Loans and advances, we know that is the bank's main business, to generate income by giving loans and advances to the customers. Loans are basically having some term nature, right? Advances having some, temporary nature, like, overdrafts. They are like advances, giving some, loans for a shorter period. And in the balance sheet, on the asset side, this is the largest item on bank's balance sheet asset, on asset side. Okay. Then the bank has fixed assets. Fixed assets means basically immovable assets like, buildings, plants or machinery. Uh, Sometimes other assets like, even the goodwill, the banks, the trade name, those all can be included as fixed assets of the bank or other assets. So you can call it fixed and other assets. Simply, these are the financial resources uh, that the bank has in its possession, right? So what the bank owns, that's on the left hand side of the balance sheet. On the right hand side of the balance sheet, you have the liabilities. Liabilities indicate what the bank owes or what the bank is required to pay for others. Liability means you have a responsibility to settle or pay back. So liabilities are simply indicates how the bank has been funded, funds that the bank has acquired from the others, or what the bank owes to others, mainly savers, right? Banks are getting money from the savers, so they are mainly liable to pay for savers, which means that the deposit holders. But other than that, there are some other liabilities also. So if you look at the liability side, there are three main liabilities on the bank balance sheet. Sorry, bank balance sheet. What are these three liabilities? Deposits, borrowings, and capital. Deposits, I already mentioned to you what the bank is collecting from the public. So bank is paying an interest and collect these deposits in various forms: short-term deposits, long-term deposits, current form, savings form. Likewise, there could be various types of deposits. Even the foreign currency, domestic currency deposits are there. Banks also borrow for their funding needs. Banks mainly borrow from actually from other counterparts like in the interbank. So within the interbank, they do borrowings on a daily basis. As I said, that coal market. Remember, in the coal market, they do borrowing, and also they can borrow on long-term basis also. For example, bank can have a stable credit line from another bank or a international institution. So that is basically borrowing. For those borrowings, banks are paying interest. Then the banks have capital. Capital, you can write it as actually the shareholders' money. Capital is simply shareholders' money or capital accounts. You call them as capital accounts. There you have couple of items actually. The stated capital, which means what the shareholders have brought, equity capital, it's there. And then you might have some other elements of capital, for example, retained earnings, right? Retained earnings are undistributed profits. Banks sometimes in some years they don't distribute profits. They keep it as a kind of a reserve without distributing. You call it as retained profits. And also under capital accounts, the banks can have other reserves, various reserves. For example, for their contingency purposes, they can create a reserve, sinking funds, which means to keep some buffer against a certain shock that the bank would face in the future. So I hope it's very clear. I am not trying to draw this T account on the board. So the way I express, I think it's very clear for you. The left hand side, you have the assets, and the asset contains these four areas: cash, investments, loans, and advances. Fixed assets. On the right hand side, you have the liabilities, where you have the deposits, borrowings, and the capital broadly. There could be other items. If you look at a balance sheet, you might get headache because there are a lot of items, even known names, unknown names, whatever. But this is the most simplest way of putting the balance sheet into a kind of a certain format. Okay, so these assets and liabilities are related to on balance sheet activities. Why it is related to on balance sheet activities? They are recorded on the balance sheet, and simply the difference between these assets and liabilities are indicating the bank's net worth or the equity capital. As I said, in these capital funds, you have equity part, what the other people have borrowed. So to do that, you can simply take the difference between the total assets and liabilities excluding the capital. So if you do it, you get a value called net worth or the equity capital. Net worth is really important variable for a bank, indicator for a bank, because that suggests the bank's strength in the case of a uh, vulnerable situation. So when the bank is having a strong net worth, it indicates the bank is able to absorb shocks. Now sometimes banks are required to absorb their non-performing loans, which means you have to write off, and you absorb that to the balance sheet. So when you are absorbing that non-performing loans as kind of a written off liabilities, written off assets, what you can simply do, you adjust it from the uh, capital. So you absorb that into capital. So as I said, the capital part is having some other components like accumulated or retained profits, and this is a kind of a buffer for the bank's unforeseen events and to absorb the risk of losses. Now, the how this is related to bank's business model, as I said, this on balance sheet activity. If you look at most of these activities are, most in the sense almost every activity here, related to interest. Either you earn interest or either you pay interest, right? Especially for deposits, you pay interest. For loans, you earn interest. For investment, you earn interest. So this interest income, you call it as interest income minus net interest expenses as net interest income, NII, right, is the income derived from the balance sheet. That is the point I want to highlight. Banks generate interest income from the balance sheet activities. So balance sheet activities I already covered under on balance sheet activities. So these on balance sheet activities are generating net interest income for a bank. So in some cases, you call them as fund-based activities or interest-based activity. So if you see the term fund-based activities or interest-based activities, that simply indicates on balance sheet activities where you earn interest out of the transactions you do a particular customer or or with another bank. So that is simply generating interest income. Now in the bank's balance sheet, this part is the most significant in, at least in traditional or emerging developing banks. So most of the banks are reliant on interest income or the fund based activities. I hope it's clear. Okay. Now then I have a sample here to show what I have discussed under this on balance sheet activity. So this is extracted from a textbook, Mishkin's Economics Money Banking textbook. There you have a sample balance sheet of a bank or the banking industry. So in the banking industry, what you have is simply this balance sheet with assets and liabilities. So on the balance sheet, as I said, on the asset side, it's on the left hand side. I already covered these items. Reserves and cash items, I told you. Reserves means what is available with the central bank. Cash is basically cash in hand. Securities means investments, what I have covered earlier. Loans, I already mentioned to you, loans and advances. Other assets, I already mentioned to you, the real assets, simply the banks, what I have used the word here as the fixed assets, right? Or any other uh, related assets. And if you look at this is for US case, if you look at this balance sheet, the most important category is actually the loans. If you add up all these loans, I think it becomes to around, so let's say, 60%, right? So 60% of the banking activity is coming from assets under loans, right? Loans, or rather, I would say like this: 60% of the assets are coming from loans. So the uses of funds are simply reflected by loans, and others are given as securities or any other assets. On the liability side, which means sources of funds, how the bank gets money. So there you have a couple of liabilities. As I said, you have deposits, you have borrowings, you have capital, right? So three items that I have mentioned: deposits, borrowings, capital. So in this sample balance sheet in the case of US around 2003, what they have, these deposits, different types of deposit, checkable and non-transaction deposits, means basically term deposits. So if you add up all these, total comes to around 70%. So the banks collecting money mainly from the uh, depositors. That is the idea. Even they do some borrowings. Capital is always small. So that is one of the peculiar or some strange uh, attribute or a feature of a bank. Compared to depositor money, the bank capital is really, really small. So that's why we always say banks are doing business on other people's money. So their shareholders here, they have only contributed 7%. This 7% actually, because it's the regulator requirement. The bank should have a minimum capital. That's why bank at least having 7% here. Now it is 10 or 12 under these new guidelines. But other than that, if there is no requirement, this ratio could even be even further low. So since central bank is imposing some requirements, capital requirements, banks are maintaining at least that part. Currently, in modern case, it's the capital is divided to certain segments like tier 1, tier 2, likewise. So tier 1 has a separate value, tier 2 has a separate value, likewise. Now the capital levels are different, but if you look at the principle broadly, the capital is less, or it is very confined to the regulated or required amount. Banks, they do not want to keep more than capital more than that level, because you can't earn out of that. So if you want to earn, either you have to lend it or you have to invest it. So banks are keeping, always maintaining the minimum or the required level of capital. So this is simply a balance sheet for the US economy. Now I have an example from the Sri Lankan context. This I have extracted from a financial statement or an annual report of a local bank. Now, I have not given the bank here, but probably by looking at, if you are working in this bank, someone would be able to identify the bank. But here we don't need the bank. We are simply using this for illustration or learning purposes. So I have extracted this from the particular annual report, and I have put it in the T4, T account form. But in the annual report, you have this as a list. First you have assets, then liabilities, then equity likewise. But I have put it here as a T for you to get some understanding. Now, if you look at the asset side, now there are various items, as I said, remember, a hell of a lot of items here, but the broad four categories that I mentioned, you can identify. Now look at the asset side, these four items actually: cash, equivalents, balances with the central bank, that is SRR money, placements with banks, reverse repurchase activities. All these are considered as cash. Reverse repurchase activities agreements means simply what you have given money to other people on short-term basis. They are highly liquid instruments. So these four items, you can consider them as, simply cash. And then you have other items: derivatives, financial assets for trading, financial assets held for trading, pledge and as collaterals. All these are actually, what does that indicate? Investments, right? And here also a part financial investments available for sale, held for maturity. All these are investments. So investments you can identify here and here. So both are basically can be classified under that broader category investment. Then I told you banks are giving loans and advances. So if you look at these few categories: loans, receivables to banks, loans and receivables to other customers, which means that is the private sector, other loans and receivables. Now, if you look at, out of all these elements or the items, the most largest one is the loan and receivables to other customers, which means loans given to people, loan given to their ordinary customers. So that indicates the broader category that I have mentioned as the loans. Then finally you have fixed assets or other assets. As I said, they are basically given in many categories, many items, as given here. You have property, plant equipment, and you have intangible assets. That's what I said as the maybe the bank's trade name, their goodwill and all that. Even the deferred tax assets, all these are coming under other assets or the fixed assets. So roughly we can classify into the four areas that we have identified. On the liability side, on the top you have those first two broad categories. What are they? Deposits and borrowings. Now if you look at, due to this part, due to banks, derivative financial instruments, securities sold under repurchase and other, all these things are indicating borrowings by the banks from other parties. There's a broad or large item here due to customers, that is basically deposits from the customers. So what is due for customers? And if you look at that, that is the largest liability item. And in addition, there are other liabilities like you have to pay taxes, you have to make provisions, all these are liabilities. And the other part is equity. So in equity part, as I said, you have stated capital, which means the equity capital brought by shareholders. Then you have reserves. Reserves are various types of reserves are there: statutory reserves, other reserves, retained profit, which means undistributed profits likewise. Now, if you look at the liability side, the broad three categories can be identified in that way: deposits, loans, and capital. So that is simply on balance sheet activity, and any of these activities are actually deriving interest income or interest expense to the bank. So in this part, what the bank is deriving interest income through investments or loans. In this part, the liability part, the bank is simply deriving or incurring expenses in terms of interest. So interest income expenses is very clearly identified, and that is related to banks interest-based activity or fund-based activities of banks. As I said, traditionally, the banks were relying on these fund-based activities or interest-based activities. Even now, countries like Sri Lanka, our banks mainly relying on these source of funds. So sorry, source of profits, which means uh, fund-based activities or interest-based activities. So that is one segment. Then we can look at the other type of banks business activity, off balance sheet activities. Off balance sheet activities. Off balance sheet activities means, by name, off means, what do you mean by off? Balance sheet is not off, right? Balance sheet is there, but these activities are not recorded in the balance sheet. They are recorded outside the balance sheet. So any asset or debt or any financing activity which is not recorded in the bank balance sheet, we call it as an off balance sheet activity. Why it is considered as off balance sheet activity? These financial transactions do not create any asset or a liability to the bank. Any asset or a liability to the bank, they do not create. So what do we have under these off balance sheet activities? Neither they considered as assets or liability, but they are simply considered as contingencies and commitments. So contingency means it's a kind of a temporary thing. Commitment is a kind of a temporary thing because it's there and it is being used or utilized. Now, if this contingency is utilized or the commitment is utilized, then it could become an on-balance sheet activity. Now, I will give you an example. For example, a credit line, right? So bank is giving a credit line like a contingency for the customer or a commitment by the bank to have a credit line to the customer. So for keeping that credit line, the customer will make a payment, but it's not utilized, it's there. So if the customer utilizes that credit line, what will happen? Then it is a loan to the customer. So that will be written under his name in his books. So then the contingency or the commitment becomes a liability or an asset. So until and unless the assets and liabilities are recorded on the balance sheet, they are treated as contingencies and commitments, which means an off-balance sheet activity. So there are some various off-balance sheet activities: providing financial services, derivative trading, providing LCs. LCs means, for example, in import-export service trade, you have to have this document credit, which means an LC. Bank guarantees means simply giving some assurance, guarantee in transactions. This is not any asset or a liability, it's like providing a service. Underwriting we'll discuss last week also. Maybe the bank is facilitating a security issuance. Forward exchange contracts means exchange transactions. Normally, banks do engage in foreign exchange activity. These foreign exchange activities earning some charges or fees, not interest. So, as a result, any of these activities would not earn any interest. You cannot ask any interest for security underwriting because you are providing a service. So, as a result, you are not giving any or paying any interest on that. You only pay a fee or a charge for that service. So in that sense, off-balance sheet activities are generating fee-based income to a bank. Fee-based income. So these are fee-based activities. So I think it's very clear now. Banks are doing on-balance sheet activities, which means fund based or interest based activity, or else banks are doing off balance sheet activities, which means fee based activities. There you don't get any interest. So this is an example for fee based activity or balance sheet activity. This is for the same bank. Now I told you this is not reported in the balance sheet. These information you cannot find out in the balance sheet. If you look at the balance sheet, under the bottom line of the balance sheet on assets and liability statement, below the bottom line, you see a term. What is that term? Commitments and contingencies. That indicates off balance sheet activities. There you have only a simple line, commitment and contingencies. Under this balance sheet, we have this balance sheet, no? So they are like, let's say, below this total assets and liabilities and equity, there you have a one line item, commitments and contingencies. To find out details, you have to go to the notes of the accounts. Every financial statement, annual report, they have the summary as well as notes to each and every account, because each and every item element of this balance sheet has some explanation, some justification, etc., etc. So those are given under notes. So for that matter also, commitment and contingencies are explained in the notes. So commitment means, as I said, commitment for unutilized facilities. So bank is giving a facility, but it's not utilized. It's a commitment. Contingencies liabilities, as I said, banks are providing acceptances, document credit guarantees. All these are earning fees, not interest. These instruments we will be discussing in a separate session. So as a result, I'm not going to define these things. These are some instruments used by the banks to undertake their activities. Foreign exchange transactions are here. Foreign exchange contracts and currency swaps. There you don't use any interest. Basically, you use the exchange rates, the difference between current rates, future rates. That is basically the fee that they are generating. So all these activities, you can call them as off balance sheet activities or fee based activity, generating some income to the banks. Okay. Any questions up to that point? Do you have any issues? Not clear? Any area? Are you there? Sleeping? or dreaming, or surfing your Facebook? What are you doing? Any questions, anyone? Can we move forward? Okay, Tishara, let's move forward. Can I ask a question? Do you have the past papers with you? Let's say, do you have the uh, latest paper available for us is actually the September 2019 paper, because we did not have exam in March 2020. Do you have the exam paper September 2019? You have. Okay, so which means now you can relate to the matters that we are covering here to your questions and answers. So probably I'll be looking at some questions and answers once we complete this session. So very quickly, let's move to other areas. Bank services and activities, what they are providing. So bank activities are in various forms. Retail banking, which means they are dealing directly with individuals and small businesses. There are business banking, providing services to mid-market businesses, some facilitating the business activity. Corporate banking, that is basically directed to large business entities like corporates. Corporates means huge companies, basically listed companies. For them, the banks are providing corporate banking. Every bank institution has a corporate banking unit, right? Retail banking, sometimes you call it personal banking unit. Uh, and as I said, or the private banking unit, that's there. Private banking means that is a specific area providing wealth management services to high net worth individuals, and banks are also providing investment banking related to financial market activities. So those are some various forms of banking provided by the banks. And also offshore banking is provided by banks, which means providing some facilities to uh, uh, entities established overseas but doing transactions locally. That is one way. For example, let's say a foreign company is established in Sri Lanka. Their transactions are happening in foreign currency. Let's say an export company, their transactions are in foreign currency. So that foreign currency part can be handled by an offshore banking unit. Every bank has a offshore banking unit, OBU, or sometimes you call it foreign currency banking unit, FCBU. And also some banks have foreign bank branches for the same purpose, and also to attract other clients who are living abroad. So that is also. And universal banking, that is also a concept developed in uh, recent, I think during last 20-30 years, maybe 40 years. Universal banking means like you are not providing banks in the universe, right? Which means you are not providing banking services to Mars, Jupiter, or Uranus. It's not like that. Universal means you are providing various banking activities or financial services under one roof. For example, in German, this is very common, universal banks. So under these banks are providing various services. For example, these banking activities like corporate banking, investment banking, offshore banking, and also banks might be providing insurance, bank might be providing leasing, wealth management, investment, different activities under one roof. So that is called as universal banking. So that there was a trend, as I said, in Germany sometimes back, uh, banks having expert knowledge and also to economize in terms of cost efficiency, banks started providing various activities under one roof, universal banking. In other words, what I am telling is these are doing both on balance sheet and off balance sheet activities in a large scale. Mostly when the banks are providing these type of banking, it's actually on balance sheet transactions. But if you have universal banking, most of the time you have off balance sheet activities as well, or financial disintermediation. Off balance sheet activities indicate some disintermediation that is also happening in the banking sector, right? Now I'll give you two or three questions here from the exam paper. You have to think about some answer, do some background work, and come to the class next time. I'll be basically looking at your answers related to these banking services. So what are the banking services under current scenario, some developments actually. So one area is, I'm typing here so you can take a note and try to bring some answer for me next time. One is bank assurance. That is one type of service provided by banks. Okay, one model of banking. The other one I want you to look at an answer is branchless banking. Branchless banking. That is also a kind of a new, or not actually so new, but some trend that we are discussing under banking sector models, different models. As I said, there are various models. No? So those two questions actually from the very latest paper, as I said, in 2019 September paper. So I just want you to try to find out some answer for this thing. Then you will do some, homework actually. Okay? Just looking whether I can give you another question. Okay, that's enough for that part. So you have to remind me, if you are really honest, next week if I don't remember, but make sure that you try to find out an answer with it. Then bank services activities we already, I think, covered. I am not going to discuss them in detail. Deposit taking, borrowing, lending, investment, payment and service providers. I think this is, I already explained in a previous slide, so we can simply skip that part because we already covered. Now, related to, I want to tell one thing here, related to this different bank services, there are some questions in your exam paper related to these products. Okay, I'm discussing different products later, But keep that in mind. You have to know some various types of products that you have under these different banking services. Now, for example, we know banks do lending. Now, when you say lending, there are various types of loans, products. Now, there is a question in the paper 2019 March. You have to define one particular product with their purpose and importance. That is consumption loan. So you need to know what is a consumption loan. You can't simply say a loan given for consumption, right? But you have to have some clear understanding how it works and what is the purpose of these loans. So that part, when we talk about some products going forward, you will have some clear understanding. Okay. Then we are moving to a very important area, right? This is important because in most of the papers, you have this question coming in different ways. Risk. Okay. Financial activity is related to risk, and that is inherent. We know finance is not finance without risk. It's always there, risk is there. And banking sector, uh, we have most of the risk that we observe in the financial system. So most of the risk are applied to the banking system. So here we are going to discuss key risks faced by a bank. These risks, as I said, there are various risks, and they are facing these risks when they conduct their banking business. And we have to know them very clearly, definitions, because in your papers, such definitions are, they are very, the examiner is very particular on giving a very clear definition for each and every risk. Okay. So let's start with the different risks. Banks are facing credit risk. Credit risk means simply risk is always related to a loss. That I want to say at the beginning. Risk is simply the uncertainty, right? Uncertainty that is leading for a loss. That is the risk. So loss could be financial, could be reputational, whatever, but that uncertainty is arising and leading into a loss. That is the idea. So credit risk or a credit loss is basically coming from the risk that the borrower is not paying back the loans or the investment as promised. Borrower or the investor, let's say if the bank gives a loan, then you have borrowers. Banks makes an investment, then you have an investor. So borrowers or investors are not paying back as promised. So that creates a credit risk. Sometimes we call it as the default risk. I think that's the most familiar word. Default risk. Default means you just forget or you just ignore paying. So that is a risk to the bank. The biggest risk in financial intermediation is the credit risk or the default risk. Okay. Then we have liquidity risk. Liquidity risk means, I told you, the tradability is indicated by liquidity. So if you can't trade security or any asset quickly enough to realize a profit, you could make a loss. So in other words, risk that is arising due to inability to trade quickly to make a profit. That is simply the liquidity risk. Sometimes the liquidity risk can be identified as banks are not having enough cash, ready cash to make payments. That is also liquidity risk. For example, when people ask for their money back, depositors, you cannot pay back. That is also liquidity risk. Inability to pay back. Okay. Market risk. Market risk is basically coming from changes in the market prices. So here I have given you a detailed definition. The risk that value of a portfolio, either an investment or a trading portfolio, will decrease due to change in prices. So what are these prices? Market prices. What are the market prices? Interest rates, asset prices, exchange rate. So as a result, market risk can be classified under various risk subcategories, like you can say interest rate risk, which means loss arising due to interest rate changes. You can say asset price risk, which means risk arising due to asset price changes. Exchange rate risk, which means risk arising due to changes in the exchange rates. So market risk simply is changing in market prices, which leads to interest rate risk, asset price risk, or exchange rate risk. You don't have to have all together. Can be one. Interest rate risk, if you're only facing that, that could be a market risk. So this is an important risk that the banks are facing. This is very much applicable for banks' investment portfolio, right? I told you, banks are doing investments. So when they do investments, the changes in interest rates, asset prices, exchange rates, that affect their market risk, or that leads to their market risk. And there are some other risks like operational risk, which means risk arising due to failures of company business functions, right? Now every bank has a kind of a setup, an operational hierarchy and operational setup. And if there is a breakdown for these operational mechanism, that could lead to an operational risk, sometimes due to system risk or whatever, computer systems or whatever breakdowns. There could be some operational risk that you can run the business as usual. Reputational risk, which means bank is losing their trustworthiness. Now, for example, a single thing could lead to a reputational loss. Now I see on Facebook and other media, some people, they criticize particular banks. They say, don't go to this bank, this is the way they treat, this is how they hammered me. Likewise, when people do such, things in these days, that could lead to a large reputation loss. If a bank is unable to pay a large deposit one particular day, that could lead to a reputational risk. If the bank is, not adjusting interest rates or whatever as expected, or it's against the bank's central bank regulatory actions, then it could lead to an operational reputational risk. Macroeconomic risk coming from changes in the aggregate economy. Now, macroeconomic risk is coming from what? There could be low economic growth. There could be high inflation. There could be high exchange rate depreciation. All these are macro variables that be reflecting that will be affecting the bank's performance. Now, for example, if there is a growth deceleration like we have in the first quarter, the economic growth is negative, means people are not getting enough income to pay back. So that could lead to a default risk. So the macroeconomic risk could create other risk also, like market risk, like default risk. So that is also really important. In modern times, The cyber risk is also one of the important things associated with the disruptions to the companies or the banks information and information systems, right? So in modern days, most of the banking activities, actually 100% activities, are automated or computer based or ICT based. So if any cyber breakdown or the system breakdown, cyber attacks, hacker attacks, likewise, information stealing, those are also happening now. Attack in the websites, releasing viruses, right? All these are kind of risks that are impacting the bank's day-to-day actions and the reputation, creating a negative sentiment uh, through the information and information systems. So those are the key risks faced by banks, and I think you need to have some idea about these risks. And banks are having some risk management methodologies uh, for these risks, to face these risks. For example, banks are having various measures taken in advance, right? I'm not going to discuss them in very detail, these risk management attributes, because this capital, profitability, liquidity, all these I'll be coming back in the last session. The financial or banking regulation, under that part I'll be covering. But very simply, what I want to say, banks are adopting measures to mitigate these risks. Now, there are various risks now. So to address these risks, banks are having risk management aspect. So every bank is having a risk manager, right? Risk management division. And there is a kind of a team to look at these things. And in addition to that, banks are trying to maintain a minimum level of certain things to face these risks. One thing is they should have enough capital, right? When you have enough capital, any default you can absorb. Profitability, if you have enough profits as measured by return on assets and return on equity, any market risk you can absorb in a short term manner, right? You don't have to worry. If you have enough liquidity, which means you have enough buffers, liquidity management is very prudent. ALCO means banks are having asset liability committees. If their functions are really doing well, then you can address liquidity issue. Management is really important everywhere. Governance is really important everywhere. Governance is a very recent concept, that you have proper systems and controls, right? Again, I will be discussing these definitions in detail when I come to that session. Compliance, that is also important. You don't have any good outcome if you have capital or whatever the things, if you are not complying with the requirements. The prudential requirements are applied or imposed by the central bank or the government. The bank should adhere to these things. These are issued in terms of regulations, guidelines, and all that. Bank should comply. And in banks, you might know, there is a chief compliance officer, right? For risk manager, there is for risk, there is a risk manager. To look at this compliance part, there is a kind of a key compliance officer as well. To capital, profitability, liquidity, all these are under the responsibility of, I think, chief operating officer and the chief financial officer, COO, CFO. And for all these matters, I think the bank CEO, chief executive officer, is responsible. So in that way, the bank's management setup is also aligned to look at these risk aspects and to manage these risks in a prudent way. So with that, I think I would like to conclude the session. So you have to do two things before you come to the class next week. You have to look at the past paper, as I said, and I'll be discussing some past paper questions last week. I think next week. Sorry, next week. Next week in my session, I'll be able to complete this session, and I'll be going to some of the past paper questions. So you have to look at a few. If you have a couple of past papers, bring them to the bring them with you when you log in. And also what I have highlighted here, two things: bank assurance, branches, banking. You have to have some idea. Okay. So let's meet next week, same time, same way, online, and have a good weekend, good week ahead. Thank you.